Silver didn't creep higher, it ripped. Mid-80s to pressing $100 in weeks, not months. Weeks. And if you're only watching the price, you're already behind. Because the real signal isn't on the chart everyone's staring at. It's underneath. In the physical market. In the friction that shows up before price does. If you're stacking silver, if you've been watching metals, if you think you already missed this move, stay here. Because what's happening right now has happened before. Same pattern, same pressure, same violence when it breaks. And there's one signal almost nobody is watching. It decides whether this move pauses for breath or detonates into something nobody's positioned for. Your job isn't to predict the top. It's to understand the structure while it's building. Quick thing. If this is the kind of breakdown you want early, hit subscribe. We don't chase headlines here. We track stress before it becomes obvious. Comment watching if you're following this live. Now, let's peel this back. Silver's trading near all-time highs in early 2026. Spot prices in the mid to high 90s, pushing toward $100. That's a 30+% surge in a few weeks. This isn't a slow grind. This is vertical repricing, and most people are calling it a breakout. Maybe it is, but that's not what matters. What matters is what's screaming underneath. Physical premiums rising, even at these elevated prices. Lease rates tightening, that signals metal scarcity. Warehouse inventories draining quietly. And here's the kicker. Paper markets are lagging physical demand. Futures aren't leading, they're reacting. Most people watch price. We watch flow and friction. Because price is loud, stress is early. If you understand what I just said, you're ahead of most professionals watching this sector. Not because you're smarter, because you're watching the right signals. So, here's what we're doing today. I'm walking you through two mechanisms that explain why silver moves the way it does, not predictions, patterns. Then I'm giving you the exact watch list I'm using this week to interpret what happens next. Let's start with what everyone sees, then dig into what actually moves this market. This is where silver stops behaving like a chart and starts behaving like a rationed commodity. Here's the first mechanism, the physical pressure valve. Think of it like this. Pressure builds behind a valve. Demand rises, supply tightens. Industrial buyers don't stop needing metal. Investment buyers arrive suddenly when fear or opportunity hits. The valve is price. And when pressure builds long enough, price doesn't move smoothly. It releases, fast, violent, emotional. This isn't theory. It's how physical markets work when structural deficits meet surging demand. Silver's been running a supply deficit for years, not a little one. A real one. Industrial use, solar panels, electronics, EVs, doesn't vanish when prices rise. That demand is sticky, inelastic. But investment demand? That's different. It arrives in waves, suddenly, often late. When both collide, price becomes the release valve. And here's why this pattern repeats. Same flow dynamics, same human behavior, same market structure every single cycle. Right now, we're watching it happen again. Price jumped from the mid-80s toward $100 in weeks. Not because analysts changed their minds, because physical buyers started competing for available metal. That's the valve opening. Why it feels sudden? Because pressure was building quietly while everyone focused on technical charts and resistance levels. Why dips vanish faster than expected? Because physical buyers are waiting. Every pullback gets absorbed. Circle this. When investment and industrial demand collide during a deficit, price is the only variable that can adjust. And it adjusts violently. You've seen this before. 2011, 2020, different catalysts, same mechanism. Industrial demand stayed firm. Investment demand arrived fast, price ripped. This isn't predicting what happens next week. It's recognizing the structure underneath the move. Once you see it, you'll spot it every time it repeats. Not telling you to buy here, showing you why it moves the way it does. And here's where people get trapped, thinking paper markets lead. Second mechanism, the paper to physical lag. Listen carefully. Futures markets don't lead, they react. Physical stress shows up first, always. Here's how it works. When physical metal gets tight, you see it in premiums first. Wholesale buyers paying more over spot. Retail premiums spiking. Delivery delays extending. Then lease rates move. That's the cost to borrow physical metal. When it's scarce, lease rates spike. Sometimes they invert. Short-term rates jump above long-term rates. That's panic borrowing. Only after physical markets start rationing does price on futures exchanges catch up. This lag repeats every major metal squeeze, every single one. Because futures are paper contracts, most settle in cash. Physical delivery is the exception, not the rule. But when buyers actually need metal, when they want delivery, not just price exposure, the game changes. Suddenly, paper price doesn't matter. What matters is, can you get metal? How much premium do you pay? How long do you wait? Think about that. If you're watching COMEX futures and calling that the silver market, you're watching a lagging indicator. Physical markets ration first, futures reprice late, and right now, we're seeing the lag in real time. Physical premiums elevated despite already high prices. Lease rates tightening, inventories drawing down. But futures volatility? Still relatively controlled. Open interest steady. No panic yet. That's the lag. And here's what makes this dangerous. If physical stress continues while paper markets stay calm, the snapback is violent when futures finally reprice. Imagine you're a market maker. You're short silver futures. You think inventory is fine because exchange-reported stocks look stable. But physical buyers are draining metal outside the exchange system. Wholesale markets tightening, premiums rising. By the time you realize the physical market is stressed, you're already behind. Covering your short means buying futures. At exactly the moment, physical tightness is starting to show up in price. That's how squeezes accelerate. Not because of manipulation, because of structural lag between paper pricing and physical flow. If this sounds familiar, it should. You've seen this pattern before, even if you didn't recognize it then. 2008. Physical gold premiums spiked while futures stayed subdued. Then futures caught up violently. 2020. Same thing. Premiums exploded, delivery delays, futures lagged, then ripped. Different metals, different years, same mechanism. And here's the part most people miss. The most dangerous setup isn't when price is ripping. It's when price stalls while physical stress increases. That's compression. Pressure building with no release. When that breaks, it breaks fast. Could it reverse? Absolutely. Maybe physical demand cools. Maybe inventories stabilize. Maybe investment buyers get scared and sell. I'm not predicting. I'm showing structure. Your job is to recognize the pattern, not time the peak. Here's what you need to sit with. The question isn't, will silver pull back? Every vertical move pulls back. Always. That's not insight. That's gravity. The real question is, what happens if it doesn't? What if physical stress doesn't ease? What if the people shorting futures, thinking this is just momentum, get caught when physical markets force repricing? What if industrial buyers, worried about supply, start locking in contracts early? What if central banks quietly shift allocations? Then you're not watching a pullback setup. You're watching a squeeze in slow motion. And here's who gets hurt. Shorts assuming mean reversion without checking physical flow. Buyers chasing momentum without respecting volatility. Holders panicking on the first sharp dip because they don't understand the structure underneath. This isn't hype. It's not a prediction. It's pattern recognition. If you've been through 2011, fast move up, sharp correction. Then another leg that shook out everyone who thought the first dip was the top. If you've been through 2020, lockdowns hit. Premiums exploded. Price lagged, then ripped, then corrected violently, then stabilized higher. Same mechanisms, different environments. And there are 3 signals that will tell us which path we're on before the crowd reacts. Let's talk about what I'm watching right now. Scenarios, not predictions, paths. Path 1, controlled consolidation. Price stalls in the 90s. Volatility compresses. Physical stress eases slightly. Premiums normalize. Lease rates flatten. This gives late buyers time to position without panic. Healthy, boring, sustainable. Who wins? Patient accumulators, disciplined traders taking profits into strength. Who loses? Momentum chasers buying breakouts. Path 2, volatile continuation. Price chops violently, but trends higher. Sharp dips get bought. Physical stress persists. Premiums stay elevated. This is messy, emotional, tests conviction. Who wins? Holders who understand structure and don't panic on dips. Who loses? Leverage traders, weak hands shaken out on volatility. Path 3. Short violent shakeout. Price rips toward 100s, then dumps 10-15% in days. Liquidations cascade. Sentiment flips. But physical buyers absorb the dip fast. This traps both bulls and bears. Who wins? Buyers with dry powder waiting for panic. Who loses? Recent buyers with no risk plan, shorts covering into the dip. Could be something else entirely. Markets don't follow scripts. But these are the asymmetries I'm watching. Now, what I'm tracking this week. Not advice? Awareness. Signal 1, physical premiums. Normal, 3.5% over spot for wholesale, 8-12% retail. Stress, wholesale above 6%, retail above 15%, widening spreads. What it means if it breaks: physical buyers competing aggressively, supply tightening faster than price reflects. Signal 2, COMEX and LBMA inventory changes. Normal, small fluctuations, stable trends. Stress, consistent draws, accelerating pace, sharp single-day moves. What it means if it breaks: physical offtake exceeding replenishment, exchange inventories becoming tight. Signal 3, silver lease rates. Normal, flat curve, low single digits. Stress, inverted curve, short-term spikes above 5 to 10%. What it means if it breaks: panic borrowing, short scrambling for physical delivery. Signal 4, gold-silver ratio. Normal, drifting in established range, 70-85. Stress, sharp breakdown below 70 or grind towards 65. What it means if it breaks: silver outperforming violently, risk-on sentiment or supply panic. Signal 5, intraday volatility near round numbers. Normal, consolidation, orderly pullbacks. Stress, air pocket moves, thin liquidity, stops cascading. What it means if it breaks: positioning imbalances, algorithmic selling, or short covering. These aren't buy signals, they're interpretation tools. If premiums spike while price consolidates, that's compression. If inventories draw while volatility stays low, that's lag. If lease rates invert while futures stay calm, that's a warning. Your job is to watch, not react. Risk cluster. Things that could flip this fast: dollar strength crushing commodity demand, policy shift, Fed pivots hawkish, liquidity drains, sentiment reversal, profit-taking cascades into liquidation, overcrowding, too many bulls positioned the same way, exogenous shock, geopolitical event, credit freeze, something nobody's pricing, macro surprise, growth data collapses, deflationary pulse. Can't predict timing, only structure. If you're a trader, respect volatility, use stops, take profits into strength. If you're a holder, accept pullbacks, zoom out, know what you own. If you're watching from the sidelines, wait for clarity. Better late than wrong, not telling you what to do, showing what to watch. Here's what separates people who survive cycles from people who get shaken out. It's not prediction, it's not timing, it's understanding structure. If you watch these signals, if you know what normal looks like versus stress, you put yourself in the group that doesn't panic when price moves violently. You're not reacting, you're positioning mentally. That's edge. Not because you know what happens next, because you recognize the pattern while it's building. This is what we do here. We don't chase headlines. We track stress early. We watch flow before price. We build the pattern library so when it repeats, we see it faster. If you got value from this, subscribe, share it with someone who's trying to understand markets, not just trade them. Comment below. What's the first signal you check each morning? Price, premiums, inventories? And if you've been through 2011 or 2020, if you've seen this pattern before, drop your lessons in the comments. The community learns from cycle veterans. Final thought. Markets don't move when everyone agrees. They move when pressure builds quietly and releases suddenly. Right now, we're watching pressure build. Whether it releases slowly or violently, that's what the signals tell us. Stay sharp, stay disciplined, stay liquid. We'll be watching together.